can sell a third the silver and make the same amount as selling it all in
Yeah.
Eagles.
So they're
And you
gouging.
know,
They're price gouging.
it reminds me of the cop that I saw in the gas station not too long ago, around dusk, and one of his lights was out, his headlights. I said, sir, your headlights. I said, good thing I won't get pulled over. I laughed and he laughed, but it's true. It's like, who's going to do anything about it? I guess is the question. I think that's how brazen this has all become.
Once an old reality is dispensed with, and the old reality was unreal. I mean, it shouldn't have been that cheap. If you lived in the 17.5 to 35% level, you go to 4. I mean, it was a nuke event. It's off the page. In other words, that spread alone says you want to buy cheap. It's a good rule. Buy low, sell high. That was low, okay? And those who bought it there are actually making money. But just to go up to the bottom end of old normality is a stunning move. And I think that move, net price-wise, when you look at a price chart of GDX or SIL, the silver miner, or GDXJ, and go back and look at that 2011 peak that they all made, I think we're going to take that out in the next five or so months.
Andy Schectman begins with a clear warning. Silver product supply is increasingly strained, and the premiums are only getting more absurd. Currently, silver eagles are marked up around $2.50 to $2.60 over spot, but that's just the beginning. As an authorized reseller one step below primary distributors, Andy explains how the real price control lies with these major players. They are the ones placing massive indiscriminate orders, $50 to $70 million at a time, cleaning out supply and creating artificial scarcity. The U.S. Mint, when out of product, essentially hands pricing control over to these large entities who become the de facto market makers. Here's the danger. When the product runs out, as it frequently does, premiums can skyrocket overnight. Schectman compares the gouging to a police officer ignoring his own broken headlight. There's no accountability. It's as if the rules no longer apply when it comes to bullion supply and pricing. And this situation isn't hypothetical. It's happening in real time. A massive shift is taking place beneath the surface. Central banks, large funds, and sovereign entities are repatriating their gold, pulling metals off exchanges and removing counterparty risk at unprecedented levels. According to Andy, this top-tier demand dwarfs retail interest and reveals where smart money is flowing. What's truly shocking is the contrast between retail complacency and insider urgency. The mainstream public still believes that retirement will come from stock certificates and mutual funds, while the insiders are dumping equities and going all in on commodities.
I would say it's probably somewhere in the neighborhood of $2.50 or 60 cents, right in that neighborhood over spot. And this is where it gets crazy, because when they run out of product, as they've shown the propensity to do continuously, and the primary distributors have it all, this is where the markup becomes absurd.
Right.
But that goes both ways, buy and sell. It's not at my level. It's at the level one above me, the primary distributors. We're an authorized reseller, which is one step below the primary distributors. They're the ones who will spend 50, 60, $70 million indiscriminately on this stuff, on Silver Eagles. Take everything that they can give on allocation. They all do that. So the mint's now out of product. And in essence, they then become the market makers and control the price. So I want to say the mint charges between $2.40 and $2.60, somewhere in that neighborhood, I would think, to the primary distributors right now over spot. Can sell a third the silver and make the same amount as selling it all in Eagles.
So they're gouging. They're price gouging.
It reminds me of the cop that I saw in the gas station not too long ago, around dusk, and one of his lights was out, his headlights. I said, sir, your headlights. I said, good thing I won't get pulled over. I laughed and he laughed, but it's true. It's like, who's going to do anything about it, I guess is the question. I think that's how brazen this has all become. But yeah, to your point, Bix, on everything, there's far greater demand up top, but you can see it. You can see it through the massive purchases, the massive deliveries, and then the repatriation, whether it be taking it off the exchanges or central banks bringing it home, removing counterparty risk. And to your point, yes, I mean, the demand is still pretty good on the retail level in comparison to where it was most of the time that I've known you over the last 20 plus years. But by the same token, it represents such a tiny, tiny bit of the mainstream. They haven't realized it yet. They really haven't. And so, yeah, what is very available and flush right now can very quickly change. We've seen that happen. Silicon Valley Bank failed. We added 14,000 clients in 45 days. That's 4 years worth of client acquisition in 45 days. But, that's really the kind of environment we find ourselves in, where the public isn't thinking, they're not forward thinking, they're not looking at this. They think the road to retirement is paved with stock certificates and mutual funds, which, to my point earlier, you have a record participation by the public in equities right now. At the same time, it's record accumulation on physical metals by the insiders. And so they flip flop. The insiders are out in equities and in commodities, and the retail public is all in equities and really pretty much out in as it pertains to commodities, at least on a large scale. So what does that portray for the future? Well, I'll leave that up to everyone else to decide. But we need people like you to keep giving us this information, the facts, the figures, and being there to hold all of our hands, because it is tough. It's tough for a lot of people to see the counterintuitive nature. What we see today, where oil was way down, the dollar was up, gold and silver, well, at last I looked, silver was up a little bit, but gold was down. Here we are filming, in the middle of this escalation in the Middle East, and gold's down $35, silver's up 4 cents. But things are counterintuitive to the way we would think it would be to react in terms of reaction. But that's all done as part of the gaslighting, as part of the cartel 101 playbook.
Once an old reality is dispensed with, and the old reality was unreal. I mean, it shouldn't have been that cheap. If you lived in the 17.5 to 35% level, and you go to 4, I mean, it was a nuke event. It's off the page. In other words, that spread alone says you want to buy cheap. It's a good rule. Buy low, sell high. That was low. Okay. And those who bought it there are actually making money. But just to go up to the bottom end of old normality is a stunning move. And I think that move, net price-wise, when you look at a price chart of GDX or SIL, the silver miner, or GDXJ, and go back and look at that 2011 peak that they all made, I think we could take that out in the next five or so months. Just as a first, no, excuse me, not the end of the move, just as this statement coming up out of the whole thing. Partly a function, again, of money moving into miners, but also, and more so than gold because of the valuation. And the fact that it's sold out. I think there's a vacuum above us. And I think it'll happen fast, where you can't, those who've doubted it for too long and don't act, they should have already acted, frankly. By our reports, it should have been in last March, really doubled up. Then GDX was 31.5. Okay, it's now 53 or something. But you don't get a chance to participate. If you wait 2-3 months from now, you'll be chasing it. No, you still may make money, but you're definitely not a smart move to get in at that point without perceiving the risk.
One of the most overlooked and dangerous developments right now is the silent structural collapse of the US dollar. The dollar index, which hit a peak in October 2022 at 115, has since been in decline. Oliver's proprietary momentum models flashed a major bear signal when the index failed to reclaim 104 in March, and the situation has only worsened. Now trading under 98, the dollar is below a critical level, 98.35. If it closes the month below this number, a decades-old structural support is broken. This won't make headlines yet, but when it does, it could trigger a global loss of confidence in the dollar. Oliver warns that the collapse of the dollar will have far-reaching implications. Foreign investors will flee U.S. stocks and bonds, amplifying volatility. For the U.S. government, already grappling with collapsing bond demand from abroad, this would be catastrophic. Perhaps the most chilling insight comes at the end. Oliver's warning about the ambush effect. Markets don't implode from the risks everyone is watching. They collapse from what no one is paying attention to. In this case, the dollar's decline and bond weakness are the real fuse. He warns that these quiet markets, the dollar index and U.S. government bonds, are the ones to watch. Once they break, it's not tariffs or inflation that will dominate the headlines. It'll be an unstoppable chain reaction. And as Oliver notes, the simultaneous momentum breakout in silver, miners, and the weakening of the dollar is no coincidence. It's the convergence of all the warning signals. A market earthquake is not just possible, it's imminent.
Often when something like this happens that we're describing in silver and the gold miners, it doesn't happen in isolation. Whereas they might have been going up for years without much events elsewhere. But when you get to this point where you start to accelerate headline type behavior, usually there's other stuff going on. And technically speaking, the crossover we just had in silver a week ago, that momentum chart I told you about, a fresh snap to the upside, born fresh again, okay? But I go over and look at certain other key markets, for example, the T-bond market. It's got a level below it that looks like that somebody's trying to support it. The buying, the tonal behavior of the market is shifted into a unusual behavior, as if central bank governments in there trying to keep it from bursting through a level. And frankly, they're bidding at right spot, because if it gets much below the lows we just saw, we argue you could get an implosion that would make headlines. It's an unreality. They'll stay an unreality, right? We're going to have government debt forever. No big deal. Okay. The other market to watch is what we call the quiet one. That's the dollar index. We know that all the fiat currencies decay at aggressive rates every decade. Our money supply grows by 90% almost every single decade, going back to the 50s. Meaning its value drops almost 50% every decade. It's real buying power. Okay. So if you bought a stock 50 years ago and you're up fivefold, you're not making any money. Okay. It's a joke. In real, how many loaves of bread will it buy? The same amount it bought then. Okay. The dollar index reached a high back in October of 2022 at 115. That was a nice little spike high, still well below levels we saw a couple of decades ago. Okay. It collapsed from that level in late 2022 into early 23 and stopped at 100. Again, the dollar index is primarily a weighting of the euro and the yen. They constitute over 70% of the inverse of the dollar index. Okay. Since 23 and 2024, it stayed in a range of about 8%, 100, 107, 8, 100, 107, 108. Actually pierced up to 110 briefly and then failed. In March, as we were pulling back, price was 104, just above 104. We said, that's it. It's over. It's entering a major bear trend. That was based on one of our annual momentum studies. We've since dropped another 5-6 points around the 98 level, just like a month ago, rebounded up to 101, like, oh boy, I'm okay. And now it's back under 98 again. Again, not super dramatic price movements. And also the percent move is not that huge yet. Even from that range, we're only a couple percent below that multi-year range. But momentum broke a structure going back a couple decades. There is another momentum trigger level we have that is a monster. It's based on 10-year average, and it happens to agree with where the average is itself. In other words, you get below that average and close a month, you'll actually be blowing a trend structure that you could plot on an oscillator. It's not just getting below an average, it's blowing a structure. If you saw the momentum chart, so if that were a price chart, you'd be getting short, okay? We're below there now. Well, 98.35 is the number. You close out this month below 98.35, and right now we're below 98. Quiet, no big deal, no headlines. You're going to accelerate the downside in the dollar where it's suddenly going to be a player. It hasn't been a dynamic force yet because it's been in such a narrow range. Suddenly it will start to make waves. And such waves as, for example, we've got the largest amount of foreign investment in the U.S. stock market ever last few years. Well, if you're a foreigner and you buy in the U.S. stock market, you own it in dollars. Mm-hmm. So not only does the S&P movement or whatever stock you own matter, but also the underlying money unit. If it suddenly drops 10% and the market goes sideways, you just lost 10%.
Yep.
Okay. So that's going to upset some owners in the stock market, but also the U.S. government bond. Just can't afford this continued process of abandonment of U.S. debt by foreign governments. And when you break that dollar more sharply, the pain for them gets even more if they're still hanging around in the bond market. So that could help accelerate that. But what's so interesting is the bonds are just above a level that we think is precipitous collapse, 110 to be precise. It's been down under 111 recently. And the dollar index is trading below a number it can't close the month below. These two factors could suddenly get into gear in a more violent way and have wave effects that weren't the topic of discussion of the last few months, which is the tariff stuff. Suddenly, something else impacts you that you weren't looking at. That's the greatest ambush effect you can get in a market, is when you're ambushed not by what you're focused on, but on something else that's also significant. And it's so interesting that silver just crossed its line a week ago, simultaneous with these two other big key markets about to cross their lines. So I don't think it's coincidental.
What do you think about this video? Comment down below. Don't forget to like and subscribe. This is Nifty Invest. We'll see you in the next video.